What exactly is multi-generational wealth and how does it differ from personal wealth building?
That's such a great question because the two are obviously very interrelated. However, I do want to emphasize that creating multi-generational wealth, it's not just about the money that you're leaving behind. If we go back even 100 years, very few people had money, had land, had stocks, right? And so realistically, their legacy was the lessons that they passed on to the next generation, right? Here's everything that I learned from my parents. Here's everything I learned from my life. And through time, this evolution happened where people got wiser and smarter and learned more things, right? And so let's not forget about that when we're talking about multi-generational wealth. We still need to be teaching our kids about money, about wealth building, about legacy, how to be a good person, obviously, right? Because the truth is that we can build multi-generational wealth in one generation.
This is the Real Estate Vibe Show, and I'm your host, Vinki Loomba. As a real estate investor and a fund manager, I'm always excited to explore the real estate opportunities for you and with you. Today, we have a very good friend, Alan Franks. And first of all, welcome to the Real Estate Vibe Show, Alan.
Hey, thanks so much for having me. Really looking forward to this today.
Me too. I'm so excited to learn from you, from all your experiences. And Alan is a certified financial planner, author, and speaker with 15 years of experience helping professionals, executives, and business owners achieve financial freedom. Known for his client-centered, tax-advantaged approach, he specializes in creating tailored financial plans and empower individuals and families to reach their lifestyle goals effectively. So today we'll discuss building and preserving multifamily wealth strategies for lasting financial legacy. So welcome again, Alan. So little bit I wanted to tell you, building and preserving multifamily wealth is about creating a lasting financial legacy and benefits not just the current generation, but the future generation, right? That's what we're talking about before the recording. And then I really wanted to learn from you, how to create that legacy for you and your family, because it just goes beyond accumulating assets. It involves smart financial planning, tax efficient strategies, and instilling financial literacy in your family. By taking a proactive approach, you can protect your wealth from erosion, ensure long-term financial security, and empower your children and grandchildren to thrive. I think that's the best way to create your legacy. So I'm going to start with this question. What exactly is multi-generational wealth and how does it differ from personal wealth building?
That's such a great question because the two are obviously very interrelated. However, I do want to emphasize that creating multi-generational wealth, it's not just about the money that you're leaving behind. If we go back even 100 years, very few people had money, had land, had stocks, right? And so realistically, their legacy was the lessons that they passed on to the next generation, right? Here's everything that I learned from my parents. Here's everything I learned from my life. And through time, this evolution happened where people got wiser and smarter and learned more things, right? And so let's not forget about that when we're talking about multi-generational wealth. We still need to be teaching our kids about money, about wealth building, about legacy, how to be a good person, obviously, right? Because the truth is that we can build multi-generational wealth in one generation. We can, right? We can also lose it in one generation. So if all of a sudden, our kids are getting these big sums of money, it can have what we would call like the lottery effect, right? Where somebody goes out and they win the lottery and then their lives just get ruined because they don't know what to do with 10 million bucks, 20 million bucks, 2 million bucks, that can happen as well because oftentimes, just like a lottery winner, oftentimes the people who are inheriting this did not earn it, right? And they're getting it. They can feel a little guilty sometimes, may just not know how to handle it. Right. So when we're talking about multi-generational wealth building, let's make certain that it's not just talking about monetary wealth, let's also make sure we're talking about wisdom and things of that nature too.
Thank you so much. I love that answer. That's pretty awesome. I know building generational wealth is something beyond getting rich, because I think often people confuse getting rich and building generational wealth. And then if you can talk about that, how are you building your legacy?
Yeah, so I think it's a great distinction here, being rich versus being wealthy, right? So when we see that person driving away in that really nice Lamborghini, that doesn't necessarily mean they're wealthy. All we really know about them is that they spent 300 grand on a really nice car, right? So unfortunately, a lot of our role models are actually rich people, right? Because that's what we see. We see the rich, we see the watches, we see the clothes, we see the cars, we see the homes, right? Well, honestly, a lot of times our heroes should be the wealthy person that's not wearing the nice watch, that's not driving the nice car. But what they're doing is instead of paying 300 grand on a car, they're going out and they're putting more down payments on more homes and they're building long-term wealth, right? Now, the truth of the matter is that there's a certain level of wealth where you can both put money down on for down payments, but also still go buy that Lamborghini. So, and typically at a Lamborghini level, you are kind of at that. So I think it's great that we distinguish wealth building versus being rich. Unfortunately, a lot of our role models are rich people and not necessarily those quiet wealth builders there. Warren Buffett, for example, who's lived in the same home for the longest time. So that being said, my own wealth building journey, I mean, it started when I was 10 years old and I would follow my father. I would follow my father into all of his financial meetings with him. And so he would always invite me. I remember vividly was probably 2006 or so, back when we used to be able to do this. I would go watch my father. He bought 10 rental homes in one closing. And I just remember the stacks and stacks of paper that he had to buy those rental homes. So he was a Robert Kiyosaki disciple. We were big Rich Dad, Poor Dad fans. We played the board game Cash Flow almost every other weekend with my brothers, and we just had a blast. And if you have kids above age 10, I would tell you that's some of the most fun that we ever had was playing that board game Cash Flow. It's such a great way to teach your kids about wealth building. And also, it's so important that every now and then, after a 3 hour board game, you land on divorce and you've got to give away half of your stuff, right? Or you land on bankruptcy and you got to give away all your cash, right? These are really good lessons to learn as a 14-year-old, right? So I would say that's where it started. But then I studied economics at Mercer University and really just took really started to enjoy not only the personal side of it, but the macroeconomic level of it. And then when I graduated in 2010, I mean, I'll be honest with you, Vinky, there were no other opportunities out there at that time. The '08 financial crisis has really hit a lot of people hard. I had an internship lined up at Lloyd's of London in London, and I thought I was going to go there and work. Now, it turns out that evaporated pretty much with all the other opportunities. So I had to actually take a commission only sales job and get into financial planning that way. And so that's kind of how I started my career in financial planning. And then since then, kind of just flash forward, we were able to borrow from a life insurance policy to buy our first home. And then we borrowed from a home equity line of credit to go buy our rental home. And then we paid those off and we went and bought a duplex and then another duplex. And so I've got about 6 rental homes. I'm not saying that's a lot. I'm not saying that's a little. I am saying that that's about as much as I want to handle right now. And so what we're doing now is I've kind of seen the light of saying, okay, I don't want to be a business owner anymore. I'm tired of having to deal with tenants and plumbing and cleaners, right? I want to be an investor. And if you're listening to this and you want to get in real estate, let me save you a ton of time and a ton of headache. Don't try to do this alone. It is so much easier to do a deal with Vinky here than it is for you to go out and try to do this on your own. Make as much money as you can at your day job, spend as much time with your family, and then let Vinky do what she does best here, which is bring you passive income. It's so much easier that way. And so what I've done since then is I've been basically an investor in things like hard money lending and also in apartment buildings, multifamily apartment buildings. We're looking at doing some climate controlled storage here soon. So that's kind of been the evolution of my personal wealth building, and starting out with the board game cash flow, going into single residential family or some duplexes as well on the residential side, to getting to multifamily.
Wow. Wow. I would say, wow, quite a journey, you know. And I mean, you have shared so much. I love that analogy, you know, the Lamborghini and then following the right people, following the wealthy people. I think that's the key right there, not following the rich people. But the thing is, in society, we just see this all shiny objects, I will call it, or the rich people showing off, and then we just follow that. Okay, that person's doing that, let me do that, or that person's doing that, I have to do that too, without understanding where we're coming from or where we wanted to go. But you had that clarity. So I'm going to ask you this question right here. So with all this, you know, you learned how to plan your future or get financially independent. But most of the time, what happens where I come from my world, you know, or I think it's kind of generic to everywhere in the whole world, you know, go to school, get good education, make money, live your life. That's about it. And the financial education, in my case, it was like zero,
Hmm.
right? So what would you say, you know, how can financial planning help someone accomplish their long-term wealth goals if they understand the difference between the wealth and being rich?
Yes. All right. So before I answer that question, I want to do two things. Number one, I want to encourage everybody listening to this who has kids to bring their kids into the financial conversation early and often there. Whether your financial situation is good or bad, we need to learn from what our parents did right and what our parents did wrong, right? We need to learn from that. And if we're not having those conversations at the dinner table, then our kids are never going to learn. They're going to repeat the same bad habits, right? Or they're not going to learn about what we really know a lot about, right? So I realize that they may not be fun conversations, but bringing up this stuff, continuously is going to help your kids at least become aware of the financial side. Even if what you're telling them is wrong, it at least is getting them to think about money, and where they otherwise would not be thinking about it. Second of all, I do want to put a shameless plug here. I wrote a book last year called Empowered Money. And this book, Empowered Money, is really designed for a younger person getting started in their financial journey, and saying, hey, if you don't have 3 grand to pay a financial advisor like me to work with you, buy this book for $20, and we're going to take it step by step here, and build you a financial plan. And the reason this is my mission, okay, this is not just a career for me, this is my mission, is because we thoroughly believe that financial planning is that one thing that if we can get that right, literally every single part of your life will get better because of it, right? Maybe it's the home maybe the shelter that's above your head gets better. Maybe the quality of food that's on your dining room table gets better. Maybe the vacations get longer and nicer, right? Maybe there's less stress and we can sleep better at night. Maybe there's more excitement about the future and we can get up out of bed earlier in the morning, right? Maybe we're able to spend more time with our family, send our kids to a better college without getting student loans. Literally every single thing in our life can get better if we get our financial planning in alignment there. So that's where our mission is, and that's why we're so eager to just give out free information, right? And we know that it'll come back to us at some point, but we really want people to start taking control of their financial futures, because it's anybody can do this.
Wow, I love that. And then thanks for sharing that you wrote a book. And then that book, amazing. Congratulations. So I'm gonna ask you this. Since you wrote the book, I wanted to ask you if you can share with us the key building blocks for creating wealth.
Yeah. So, we're going to talk a lot in this podcast today about really high level ideas, passive income, things of that nature, right? At the end of the day, it's going to sound crazy, but the more money you make, the more you need to watch your cash flow. Like a basic blocking and tackling right here is that, hey, if you're on food stamps, you don't need a budget. You know where every single dollar is going in your head already. But as we get further from being able to just take care of the essentials, as we get further from that, we make more income, then all of a sudden, the bigger the ship, the bigger the leaks. And all of a sudden, we have money going towards stuff that maybe we valued 5 years ago, but we certainly don't now, right? So, in general, our cash flow needs to be an exercise in values. Our money needs to follow what we value. But let's say that you have sports tickets to your favorite sports team and you love them and you still love them. But let's say that since you used to have them forever, but now you got a couple young kids and you don't make it out there, right? Well, maybe we should reallocate that $10,000 to something that you value a little bit more right now, right? So whether it's a subscription to HBO that you got for a show that ended 3 years ago that we need to cancel, or our tickets, or whatever it is, or it could just be the money that you're spending on food because golly, inflation is really getting the a hold of restaurants, right? We need to constantly be looking at that cash flow, and you're never going to out earn that. Now, imagine if you went into Apple and said, "Hey, Apple, you've got $1 billion of cash. Well, you need to just go fire your accounting team because it doesn't really matter where the money's going. You have so much in cash, right?" Apple would never do that, right? So if a CEO of a large corporation that's super successful wouldn't do that, then personally, we need to have a way to be able to monitor our own expenses there as well.
That's true. That's a really good advice right there. And cash flow is king. We all understand that, right? So if you can take us through your journey, how you created this consistent cash flow for yourself versus you using your own money, because there's a difference, using your own savings, using your own money, or deploying that into the investments and getting the cash flow and using that cash flow to get into things because still you're preserving your money or the wealth right there. So talk
You
about
got
that. And how did you do
Yeah.
that?
So I'm a big fan of leveraging a little bit of my money so I can leverage a lot of other people's money. All right. So
Mhm.
let's take a step back here. When a wealthy person, first of all, most people never invest money. They never save enough to be able to invest. The people that do invest, oftentimes they invest a dollar and they get a dollar working for them. That's not how wealthy people invest. Wealthy people invest a dollar and they get $1.50 working for them. And they use something called lines of credit or leverage in order to do this. So I'm a big fan of leveraging my own assets so I can go leverage a lot of other people's money, time,
Mhm.
experience, knowledge, right? So let's give an example here, right? So when I create my financial plan, of course I am doing traditional stuff like the 401k, backdoor Roths, things like that, right? So I do like taking advantage of tax advantages right now if they've got it, depending on what income bracket we are in. But also when I start investing into the stock market, right, I'm going to get something called a securities backed line of credit. And what that's going to allow me to do is borrow up to probably 65 cents, but let's say 50 cents for easy math here. So that means that every 100 grand, I can go borrow 50 grand out of that and I can send that 50 grand to Vinky and she can put it in the deal that she thinks is going to make money. And then eventually Vinky's going to pay us either interest or a dividend back plus the money on top of that, right? So now all of a sudden I've got 100 grand in the stock market. Using the rule of 72 here, as long as we average 7%, we should double that money every 10 years, right? So 100 grand will become 200, 400, 800, 1.6, right? So that's going to continue to grow for me. Meanwhile, I've got 50% of that over with Vinky, and she's making me money and giving me income, giving me dividends, right? And eventually, we're going to sell the property, we'll get our money back, we can reinvest it, right? And at some point, we can choose to pay off that loan, right? So, as a financial planner, what I am trying to do here is to get people to trust the stock market because I realize a lot of people maybe listening to this maybe don't trust the public stock market that much. I wish I had a little bit earlier, more earlier on. My dad was a business owner, real estate owner. He did not really trust the public markets. And that's really cost me hundreds of thousands of dollars because during the 08, 010 crisis, that was actually the best time to invest, right? Well, it took me a couple of years to realize that here. And I'm in this industry, right? So What I like to tell people is that, hey, your biggest cost to doing any investment, whether it's buying a stock, buying real estate, you name it, the biggest cost that you have is something called opportunity cost, right? If you do this over here, you cannot go do this over here, right? So what we're trying to eliminate is we're trying to limit the opportunity cost. And we're saying, hey, why don't we do both? Why don't we invest in the public markets? Why don't we then go borrow against that and give it to people like Vinki with really good deals? She's going to pay you interest over time. She'll get your money back when they sell, right? And then over time, we'll pay off these loans that we have so that when it comes time to retirement, and this is where I come in, and this is why I have interest in my clients doing deals like this, so that when it comes time to retirement, they already have a really good income, a passive income stream from these deals. Now all of a sudden, we don't have to rely so much on our stocks and bonds.
So you said one thing, that you said people do not trust the stock market, but I have seen, in my experience, because I come from the corporate world, and that's the only thing that we knew, other than our day-to-day jobs, like we have a 401k and then we're investing in 100% in stock market. And then I was in stock market myself for multiple years. And then my husband is full-time in stock market because people know stock market, they know they can make money, they have their own strategies, they work it. But getting into something like alternative investments, like real estate or any other alternative investment, is kind of hard for people because there's, I think, lack of knowledge, lack of education right there, which is very important, like you were talking earlier. So, and then that's where the financial planning comes into play,
Yes.
because that's the true diversification. And that's what you're talking about, the intrinsic value, or do this or that, because when you have the opportunity to do both, you can do that if you plan it right. So let's talk about that a little bit, how we
Yeah.
should bring that into our experience, the alternative investment that we did not know before, because you
Yep.
have the, I would say, the best part of the world, because you got financial education very early on. You understand how to, leverage your money, or how to use the OPM. And we can
Yep.
talk a little bit more about that too. OPM is really important. It's like other people's money. So when
Yep.
you're connecting all these dots, thanks to your
Mhm.
board games, that you learn all that, and then you're creating something for yourself, which is like really meaningful, which has a mission as well as a vision for you to go a long way. So let's talk about that a little bit. And then I think we should bring Rockefeller family in there, or maybe Vanderbilt. We can do the comparison
Yes.
right there. You can talk about that a little bit, like how one family did so well compared to the other.
You got it. You got it. So let's start off by talking about diversification here. So when we are discussing diversification with clients, there's three levels of diversification that we really want to hit on. The first level is very easy, just getting a lot of different stocks and bonds into this. That's actually, with today's technology, that's not a problem. So diversification amongst different industries, different countries, not a challenge anymore, right? The second level of diversification is, and that's asset class diversification, right? So it's too many people have all of their assets just in what we call paper assets, stocks and bonds, 401ks, IRAs, right? And so what we want to do is we want to get some different asset classes in there. We want to get some real estate in there, maybe some business in there, maybe a life insurance policy in there, right? And we want to start to build out a portfolio that is going to do well in all different scenarios, not just when the stock market is doing well, right? And then the third thing, and we're going to talk about this, I'm going to put an earmark in this, is tax diversification, right? Of course, yes, if we're in a high income tax bracket, I am a fan of maxing out a 401k, getting a tax break right then, right? But we also want some stuff that's going to have other tax advantages. Real estate is a great example of that, right? So we want those three diversifiers, different stocks, bonds, different asset classes, and different tax strategies there. Now, when it comes to building wealth in America, there are three main ways that you can build wealth. The first one, the easiest one, is to check the box during employee benefit season and put money into your 401k. Right? It's going to automatically come out. So we can remove human nature. It's going to automatically come out of your paycheck before you see it, go into 401k. Your company's then going to match that typically to some extent right there. And then it's going to grow over time, and you forget about it because you can't touch it without penalty until age 59 and a half. And so the easiest way for somebody to build wealth in America is through the stock market because it has very low minimums. It's very easy to diversify and mitigate risks there, right? And it's very easy to do, right? And once again, there nobody's calling you to complain about the tenant next door or the plumbing issue that we have, right? So it's very, in general, it can be very passive, right? So that's the first way. That's the most common way. The second most common way is real estate, right? Because to build real estate wealth, all you got to do is own the home that you're living in, right? If you own the home that you're living in over the last 5 years, your net worth might be up 50% right now,
Mhm.
right? And so as long as we understand that as long as we own that home, we are in the real estate game. The question is, okay, how can we amplify that? Because the beautiful thing about real estate is this idea of leverage. Okay, let's say that you went and you bought a $500,000 house, okay? And that $500,000 house became 750. It increased by 50% over the last 5 years. Not that hard to imagine that, right? Okay, well, you look at that and you say, oh my goodness, my asset went from 500 to $750,000. I made 50% rate of return. And you might be right technically, but when you look back and say, oh, did you put $500,000 of cash down on that? And you're saying, no, I didn't. I put 50 grand down. Oh, you put 50 grand down. Okay, gotcha. So realistically, your 50 grand made $250,000 for you, didn't it? Right? So
Mhm.
we're not looking at a 50% rate of return. Yeah, we are on the overall asset, but look at the rate of return of what your down payment was. And that's the power of leverage right there. So we can put a little bit down and have that asset, get an asset that we otherwise couldn't afford with cash. We're going to use other people's money to go buy this thing. We got to put a little bit down. And now all of a sudden, we've got $1 million asset that's working for us going up, right? So that's the beautiful thing about real estate. We have that ability to leverage our money and really accelerate our wealth building. And then we just finish this thought. The third way we can build wealth is by starting and selling or buying and selling a business. That is very difficult in today's world here. That's by far the least common way, and it's the most challenging way. But things like stock options, if you're in San Fran, you work for a tech company, you're going to have some really nice stock options. There's ways that we can mimic owning a business without having to start and sell something.
Great, I like that. So 3 ways to make money. I like that. So you talk about the tax strategies too a little bit. You touch on that because especially when you're in the real estate game or you're investing in real estate, you get something called the depreciation, right? Or the bonus depreciation that you get that, and you can leverage that against your capital gain, the long-term capital gain. So if you can
Yeah.
talk about that too, because that's again one of the wealth building strategy right there that you
Yeah.
mentioned.
Yeah, yeah. So I think what's really important here is that we discern what side of the balance sheet we are on when we are investing in real estate. So I invest in hard money lending, right? So I borrow against my investments at let's say 7.5% interest rate, and then I go lend out at 17.5% interest rate. So I've got a nice little $10,000 every 100 grand. I get $10,000, nice little 10% spread there, right? Hey, that sounds great, but there's a problem there. Problem is, I'm in a decently high tax bracket, so I'm only keeping so much of that, right? Now, it's very safe. It's nice income. More income's better than less income, right? But it does present a tax problem. On the other hand, I'm also invested in a 130 unit multifamily apartment building, right? And that one has a lot better tax advantages because I'm on the ownership side of that, right? So we got to say, okay, just like the public stock market, where you can buy ownership by buying a stock, or you can lend money by buying a bond there. Same thing's happening on the real estate side there, where we may want to diversify a little bit here on which side of the balance sheet we are on there, right? So remind me, what was the question? I got off
The
on a
question
tangent.
was the capital gain, how you can offset
Yeah,
your capital gain with your tax advantage from the real estate investing.
you got it right. So here's the beautiful thing about real estate is that obviously we can 1031 exchange funds whenever we sell. We actually have a great 1031 exchange fund for somebody. I would say it's a really good fit for somebody who is older. They're tired of having to manage. I was talking to somebody the other day, 70 years old, has 50 rentals, so tired of managing it, but wants to keep it for the step up in basis at death. And so what we're looking at is a 1031 exchange fund where they can roll that money into there and get a nice nice little dividend and then still get the step up at basis at death. But one of the things that's interesting about real estate is really the two main ways you can do this are real estate and then also oil and gas. We can take advantage of something called a bonus depreciation. Okay.
Mhm.
So on
Mhm.
real estate, and that bonus depreciation has gone down a little bit. It's about like 60% right now. There's some talk and some hope that they bump that back up, right?
I
But
think it's 100% now because I did see a post the other day. Somebody posted, one of my cost seg friend, that
yeah,
Trump has already announced 100%
that's fantastic. Yes.
back, but we do not know when it's going to start though.
Yep, yep. So that's going to make that a play again. At 60%, I don't think it was really worth it, right? So I'm certain that you've had podcasts on there, but you can't depreciate the land. You have to get this cost segregation, which costs money. But let's say that we've got a high income W-2 earner and we've got a spouse that stays at home and takes care of the family. All right. Well, all of a sudden, if we go out and we start getting some residential real estate, maybe we can justify that the spouse, that stay-at-home spouse, is now a real estate professional. And all of a sudden, real estate then goes from being a passive activity to an active activity, right? And active losses can offset active gains. So now all of a sudden, once again, talk to an accountant. You've got to do this right. And by the way, these things are getting audited. Cost segregations do get audited. So you got to have a really good professional there. But all of a sudden, maybe we could go buy $1 million beach house or so, which I know in California that's not going to get you not going to get you far, right? It's not even going to get you far here in Georgia, right? But let's say for easy math, we're going to go buy $1 million mountain house somewhere, right? And we're going to actively manage the rentals on that mountain house. And then all of a sudden, what we could do is do a cost segregation, do a bonus depreciation, and now all of a sudden that $1 million of total W-2 income can go down to who knows whatever the cost segregation allows it to, right? So there's a really good opportunity there to make an argument that it actually makes financial sense for you to go get a new vacation rental once a year, even if you don't make money on it. Right.
Mhm.
Even if you don't make money on it, there's going to be a cost break analysis there that we can run to see if it makes sense to go get that Lake Tahoe home or wherever you want to be. Right. So that I will say this: the other way you can do that is through oil and gas credits, right? One of the challenge with oil and gas credits, depending on what fund you go with, is that sometimes they don't strike oil, right? And also sometimes the oil markets crash, right? And so you got to know the risks that you're taking on there, but there is some nice bonus depreciation that is in there in those oil and gas credits.
That's true. I think the due diligence is very important. No matter what sector you do your complete due diligence and then you run with it. So since we talk about, this creating wealth creation strategy up till this point, different ways you can do it. You can do real estate, you can do oil and gas, you can do stock market, whatever way it works for you. Your 401k, you can leverage that. You can get the loan, you can get the private money. So you can use all these different channels to use other people's money, leverage, as well as to invest to make money. So let's talk about the preservation of wealth now. And I
Yep,
briefly mentioned earlier too, how Rockefeller, they preserved their wealth so well over, many generations.
yep,
And compared to the Vanderbilt family, they didn't do very well compared to them.
yep,
So if we can talk about the wealth preservation strategies at this time from your experience, because you've been
yep.
doing it. So share with us.
Hey, I love the story of the Rockefellers and the Vanderbilts and the fact that we have Anderson Cooper in front of us. And he was the first Vanderbilt to not get any money. And look what he's done with his life. That's such a good example of what we talked about earlier, the lottery effect of, hey, we want to make certain that our kids can do anything anything that they want, but not everything that they want, and certainly not nothing. Right. So we got to find a way to strike that balance there. Now, I will go back and I want to talk to you about me personally. All right. So, I want to talk to you about my mom. My mom's great grandfather came over on a ship. He was exiled. The rest of his family got murdered in Poland. And he came over. He taught 7 languages at Lehigh University, came down to Atlanta, started an iron ore company, and they were the bee's knees of Buckhead, Atlanta. They were part of the country club. I go by the house that they live in, and it is a mansion, right? And when I look at all the land that they used to own in the city of Atlanta and all the homes that they had, right? And I look at what my mom ended up getting as an inheritance, which is not much at all. Right, I mean, we built a hot tub with it. That's about the extent of it. We literally built a hot tub with it, right? And I look at that and I compare that to my father, who my father's father worked at a gas station. My father came down here to Life University to go to chiropractic school without anything in his name, right? He built, yeah, at one point he owned 5 practices. He built up a real estate empire. He did the right life insurance. He invested his money, right? And he created multi-generational wealth in one generation here, right? So the true answer is, okay, now that we have that, how can we make certain that my father's legacy continues for multiple generations, right? Unlike my mother's great grandfathers, right? And how can we learn that? And what I found here, what my belief is that imagine you had a fire out back. You have 3 kids. Okay, let's imagine we have 3 kids and we have a fire with 3 logs. Okay, you can individually hand them each log. Okay, but a couple of things are going to happen. Number one, that log's not going to burn as hot individually as it is together, right? Number two is that log might severely burn that kid and affect it and hurt it long term. Right. So, what I'm a big believer in is trust planning here. We have to have a good estate planning attorney. We got to form trust here. And I'm a believer of having your money go to a trust that you can then dictate the use of those trust funds. This is your money, right? I like to make certain that your money reflects your values here. So maybe we could pull money out of this trust for educational purposes. Maybe we could pull it out for sicknesses and illnesses, right? Maybe we could borrow against it to go buy our first home, right? We can figure out, we can put this stuff into the trust documents here. But I'm a big fan of keeping all the assets together, keeping it together so that they can work more efficiently and tax advantagely and cost efficiently, right? But also putting some limitations on what we can use that. Obviously, we don't want to go too far into the limitations here, right? We do want to make certain that there's some flexibility. But to be clear, typically you're going to leave stuff like your Roth IRA and your IRA outside of the trust. So maybe we leave a little bit of money outside of the trust to help the next generation. But the rest of it, I like to leave it to a trust. I like to name something called a corporate trustee on this. That way, it's not an uncle or an attorney down the street that's telling your kids that they can't take money out. It's a corporate trustee who's there to read the laws of the trust, right? And help preserve that wealth over multiple generations.
Great, thank you so much. You mentioned estate and trust. So these are the two terminology that you use, and I would like you to shed some light on both, like what is trust or what is estate planning,
Yeah,
and
yeah.
and why it's important.
Yeah. So just so you know, most people actually already have an estate, a will, right? It's just may not be a good one, right? So I know, and it's state by state. I know here in Georgia, if I pass away, all my stuff goes to Allison, my wife, right? She passed away, everything comes to me, right? Now, the challenge with a will is, okay, what happens if we go together, right? What happens if we're on an airplane and we go together? All right, well, now all of a sudden the judge is going to be in charge of dictating who's going to take over our kid, right? So that's number one, is I don't want that judge to be in position. I want to name that. Number two is that my kid is now going to get all of my money at age 18. All right, think about this. Think about where you were at age 18. All right. I know that I had an 8 a.m. econ course every single Friday, and it was hard as hell for me to get up for that 8 a.m. econ course. And I made it about half the time. Now, I want you to imagine you getting to that 8 a.m. econ course if you've got $1 million in the bank as an 18-year-old. It's not healthy. At no point is that good. I don't care how mature your kids are. That's not good, right? So those are two things that we want to take care of there. Now that's on the will side, right? On the trust side, the trust can do multiple things here. But one of the things I do want to talk to you about is that, hey, if people do enough work with Vinki here and you're listening to this podcast and you're building wealth, I want you to be aware that you may have an estate tax problem at some point. And that's a great problem to have. As a matter of fact, it's one of the best problems to have, right? But it's only a problem if we ignore it and we don't acknowledge it, right? So think about your net worth here. Let's say it's, if you're listening, it's easy math. Let's say it's $10 million, right? So it's $10 million, and let's say that we are 50 years old. All right. Well, if we have really good passive income coming in, we're not going to have to pull down on those assets. That 10 million should, by the rule of 72, double every 10 years, right? So at age 60, we're now at 20 million. At age 70, we're now at 40 million, right? At age 80, we're now at 80 million. And all of a sudden, this thing can really escalate because the more money you have, the easier it is to make more money on this, right? So what we can do though is we can move some assets out of your estate into a trust. We can have the growth of that be outside of your estate so that at death, that's not going to be part of the calculation for your estate taxes, right? And that's some really good planning that we can do. Now, to be clear, I'm not an attorney. We did introduce you to somebody like that. But this is where life insurance actually really comes in. I just want to talk about life insurance real quick because it typically and I'm a victim of this in the past, but typically when you think of life insurance, you think of that person knocking on the door and calling you and trying to get you to put $1,000 a month into permanent life insurance as an asset accumulation vehicle, right? And to be clear, I do that personally. I have clients that do that. There's nothing wrong with that. I'm a big fan of that. However, when we start talking about estate taxes and we start getting into big problems, right? Gets really fun here. We can fund that trust with a life insurance policy there. And if
Mhm.
we have assets, here's what most people don't understand is if we have assets we could post as collateral, we may not even have to pay the premiums on the life insurance. It's called premium finance life insurance, right? We're going to have the bank go and pay that premium for us, right? So it's not necessarily free, right? We might have to pay some interest, right? Or, that's money that's collateral we couldn't use on other things, right? But there's a way where we can have the bank pay for the premiums. We can collateralize the interest, so we may not even need to pay the interest, right? And all the time we're putting money into a life insurance policy that is building up a cash value. At some point, then you can borrow from that cash value to pay off the bank, and then you do have a loan, but it just comes out against the policy, but that just comes out at death, right? So we can really help give instant liquidity at death. Because the one thing that real estate does lack a little bit is liquidity here. And
Mhm.
if we are in a position where we have a lot of real estate net worth, we're going to need some liquidity at death to help pay the estate taxes. Or our heirs are going to have to sell real estate. And at that point, sure, they got to step up in basis. But what happens if your uncle? My uncle died in 2007, right?
Mhm.
And so my aunt was left with a lot of apartment buildings. I mean, a lot of apartment buildings that weren't necessarily in the best shape at that time. They kind of let them deteriorate. And then '07, '08, '09 happened. And they went from a $55 million valuation to a $35 million valuation, right? So we got to control this for the dips in the market here on this, right? And we got to provide that liquidity so that we're not forced to sell our assets. And life insurance does a really good job of that. Once again, more money you have, the easier it is to make more money. So maybe we could have the bank pay some of those programs.
Yeah, I like that. And thank you for sharing that. And I know we are out of time, but I wanted to ask you one last question. How can families or whosoever looking to start their estate planning or looking for financial planning, what are some of the common pitfalls that somebody can avoid in
Yeah,
the wealth erosion, because there's multiple leaks, like you were talking about earlier, and throughout the conversation, we've been talking about that. So how
yep.
can somebody avoid that pitfalls?
Yeah, so I would say one of the best books I read last year was a book called Who Not How, right? And the idea here is that, hey, when we think about how we can do stuff, we really limit ourselves because it means that we have to go and learn everything, right? But when we have the right who's around us, the right estate planning attorney, the right accountant, the right financial advisor, all of a sudden now I can then go focus in on what I'm best at, knowing that they're going to do what they're best at, right? So I would say the biggest pitfall here is going to be one or two things. Number one, trying to go at this alone because sure, you might be a great stock picker, you might really enjoy it, but I guarantee you that there's pitfalls in your plan. You may not know what's going on with your employee benefits, right? And we're going to sit down with you and help you choose that. The estate planning is another example. You may not care about your car and your home insurance, which is going to be that world is nuts right there. So we do an audit every single year, right? So trying to go about this alone, I think is a really scary proposition, even if you're really good at one or two areas of financial planning. There's so many areas you didn't even know existed, right? And then the second second one would be choosing the wrong who, right? And so in our industry, you tend to fall into one or two categories. You're either an investment advisor or an insurance guy, right? And so you're either
Mhm.
risk management, where you're focusing on life and disability and annuities and maybe car and home insurance, or you're an investment person that only cares about, ETFs and mutual funds and individual stocks, right? And realistically, you can go get two separate advisors there. What we try to do though is we try to bring all that in house because a good financial advisor acts like a symphony orchestra. All right. So when you look at a symphony and an orchestra here, what they do is they take all of these individual solo acts here and they put them together so that the sum is bigger than the individual parts. And all of a sudden they create something beautiful, right? So yes, we could have a great pianist, we have a great cellist, right? But a great singer, right? But when we put them together, magic, that's where magic happens, right? That's what a good financial planner does is he looks at every single one of your assets and says, here's your cash over here doing this. Here's your IRA doing this. Here's your solo K doing this, right? Here's your real estate doing this. But they're not talking to each other. They're not complementing each other. Let's pull them all together in a financial plan because if we change this over here, we might be able to keep less cash over here. Get that cash invested with Vinki here and make you more money long term, right? So having everything really come together so you can see all the levers that you can pull and how it affects other things. That's what a really good financial planner does. So talk about pitfalls. There's so many of them, but I would just say, hey, trying to go out on your own and not getting the right partner to go through life with, those are going to be the biggest things. If you can get the right partner and you get a really strong team around you, man, sky's the limit here. We can really accelerate towards your dreams.
I cannot agree more with that analogy. Seriously. Oh my God. I love that symphony analogy. And if you look at the conductor, the master, he's in a flow all the time, It's a state of flow. So by connecting all these dots, you're creating a state of flow for yourself. So at
Yes.
this point, I know we are out of time. I'm going to ask you if you can share one more golden nugget from my audience. It could be mindset, could be anything.
Yeah. Oh, one more golden nugget. I tell you what, yeah. Here's this. Okay. I realize in today's world, we have great podcasts we can listen to, like this one right here, right? We've got great Instagrams that we go, great TikToks. Don't underestimate the mental relaxation that actually reading a book can bring you. Okay. Actually reading a book can be therapeutic here, right? And so there's so much great information. There's so many ways to bring it in, but actually having to focus in on one thing every single night for 20 or 30 minutes, right, will really not only help you learn a ton, but there's this therapeutic aspect of it, right? So I've read so many great books here this last year. I would say 10x is easier than 2x is a great one too. I just mentioned Who Not How. This psychology of money. Oh my gosh, mind-blowing stuff in the psychology of money. And then right now, I'm actually reading a book, What to Say When Talking to Yourself, which is really, it really is good. It teaches you, all the self-defeating stuff when we're talking about ourselves and how to turn that on, turn that around, right? So, that would be my golden nugget is I realize there's a lot of ways to get knowledge and information. Don't underestimate the therapeutic benefits of reading 10 to 20 minutes a night.
Thank you. I love all those golden nuggets. Thank you so much for all the books as well. So this brings us to our rapid fire round. I'm going to ask you 5 questions. You're going to answer it in one word or one sentence only. Are you ready?
I'm so nervous, but let's go.
All right. So the first question is, what is one of the most important thing you have learned in your life? And how did your life change after learning it?
Um, Marry the right person.
That's very important, actually. Nobody thinks about that, but that's the best answer.
Marry the right partner.
That's so true. I like that. So I know you mentioned multiple books. So share one best book that you would like to recommend.
The Science of Getting Rich by Wallace D. Wattles.
Good one. In one word, what does life mean to you?
Fun.
I,
Fun.
I like that. I like
We're
that.
here. We're here. Let's get after it. I think too many people are, background actors in their own movie, and they need to come to the front and assert themselves and be the main star in their movie, right? Engage. right? We're too many people are just letting life pass them by. Let's engage and let's happen to life.
That's true. Sleepwalking. I think the best book at this point, I'm gonna reiterate that. What do you say to yourself when you're talking to yourself, the one that you mentioned earlier, to get out of that pattern, you know? So, what is your biggest passion?
Oh, Atlanta Braves baseball. I love Atlanta Braves baseball. That's my guilty hobby right there. But professionally, I do love real estate and tax advantages, right, and helping people reach goals. But selfishly here, obviously beyond my wife and my daughter here, I do love Atlanta Braves baseball.
Great. So, if you could turn back in time and talk to your younger self, what
Yeah.
would you tell yourself and why?
All right, this is a joke, but it's also somewhat real, right? I would say buy Bitcoin, right? Now, to be clear, be clear. That's not recommendation for now going forward. I have no clue what's going to happen, right? But there's a great movie called Back to the Future where this character called Biff goes back in time, gives his old self a sports almanac, and he gambles and he wins all these bets, right? All right. Well, I've thought about it. If we had a time machine, we just go back and just two words like buy Bitcoin, right? So once again, I have no clue what's going on in the future here, but that would be it's kind of a joke, kind of not a joke, right? But obviously we don't have that crystal ball, right? So we gotta make decisions with what we've got.
That's a good one, actually. I like it. So, share with me, how can people reach out to you?
Yes, yes. So my website is empowered-money.com, empowered-money.com. If you go there, you're going to be able to see articles that we've written, my own podcast. You're going to be able to see our news appearances that we've made here, and you're going to be able to buy the book. But most importantly, go there and do the free 10-minute financial plan on there. It's going to show you your current trajectory here of your financial plan. I just want to warn you, we are going to capture that lead. You will probably be getting us a phone call from us, but that way we actually know where you're at financially and we can cater that phone call to you, right? So empowered-money.com is the best way to reach out to us. And I look forward to talking to you.
Thank you so much, Alan. I really enjoyed our conversation today. Thanks for coming to my show. Thank you, everyone, for tuning in to the Real Estate Vibe Show. Don't forget to subscribe, leave a review, and share this episode with anyone looking to elevate their real estate investing game. Until next time, stay focused, stay inspired, and keep building your real estate vibe. Thanks again.